You have been using RSI for a while now. You know the levels. You watch for 70 and 30. You wait for the signal, and yet you keep getting in too late. The move has already happened by the time RSI confirms it. That is not a discipline problem. That is not a strategy problem. That is an indicator problem. Standard RSI was not designed for the speed of modern markets. It is a smooth, slow-moving line. And that smoothness is exactly what causes the late entries that cost you money. There is a modified version of RSI that was specifically built to solve this problem. It is more sensitive, it gives you the same signal earlier, and it adds one additional layer, a crossover signal, that standard RSI simply cannot produce. It is called the Stochastic RSI, and once you understand how to use it correctly, you will see your charts completely differently. Here are the topics we will cover. 1. The basics of Stochastic RSI and how it differs from standard RSI. 2. The 3 key uses of Stochastic RSI for day traders. 3. How to set up Stochastic RSI correctly for day trading on TradingView. 4. 2 powerful day trading strategies. 1 for trending markets, 1 for identifying reversals before they happen. These strategies work across all types of assets: stocks, forex, and crypto. This video is for every trader. With that being said, let's get started. To understand Stochastic RSI, we first need to understand what made Standard RSI limited. Standard RSI was developed by J. Wells Wilder in 1978. It measures the speed and magnitude of recent price movements on a scale of 0 to 100. When RSI moves above 70, the asset is considered overbought. When it moves below 30, it is considered oversold. The problem is straightforward. RSI is calculated directly from price. Price moves slowly and smoothly, so RSI moves slowly and smoothly too. By the time RSI confirms a signal, the optimal entry point has often already passed. Stochastic RSI was developed by Tushar Shande and Stanley Kroll in 1994 specifically to fix this problem. Here is the key distinction. Standard RSI is calculated from price. Stochastic RSI is calculated from RSI itself. In other words, instead of asking where is price relative to its recent range, Stochastic RSI asks where is RSI relative to its own recent range. This makes it significantly more sensitive to momentum changes, and it generates signals earlier as a result. The indicator has 2 components. The first component is the %K line. This is the fast line. It moves quickly and reacts to momentum changes first. The second component is the %D line. This is the slow line. It is a smoothed moving average of the %K line. It moves more gradually. These 2 lines interact with each other, and that interaction is what produces the most powerful signal this indicator offers. We will cover that in detail in the strategy section. Like standard RSI, Stochastic RSI operates on a scale of 0 to 100. When both lines move above 80, the asset is in the overbought zone. When both lines move below 20, the asset is in the oversold zone. Now here is the most important concept in this section. And the same mistake traders make with standard RSI applies here too. Being overbought or oversold is not a trade signal on its own. In a strong trending market, Stochastic RSI can remain in the overbought zone for many candles in a row. Selling every time it crosses above 80 in an uptrend leads to consistent losses. What separates profitable Stochastic RSI traders from unprofitable ones is understanding that these zones only produce reliable reversal signals under specific conditions. We will cover exactly what those conditions are in the strategy section. Now, let us cover the 3 key uses of this indicator. The first use is trend identification. Stochastic RSI has a midline at 50. Most traders completely ignore this level. This is a mistake. The 50 midline tells you the trend bias for the session. If the Stochastic RSI is consistently making moves above 50 and returning to it as support, we can classify this as a bullish session. We should focus only on buying opportunities. Similarly, if Stochastic RSI is consistently making moves below 50 and returning to it as resistance, we can classify this as a bearish session. We should focus only on selling opportunities. This single filter is Stochastic RSI above or below 50. Immediately eliminates a significant number of losing trades. The second use is overbought and oversold zones. The 80 and 20 levels mark statistically extreme areas of momentum. When Stochastic RSI moves above 80, buying momentum has become unusually strong relative to its recent range. When it moves below 20, selling momentum has become unusually strong. In a ranging sideways market, these zones produce reliable signals. Price tends to reverse when momentum reaches these extremes. In a trending market, they do not. A strong trend can push Stochastic RSI into an extreme zone, and keep it there. This is why identifying the market condition first is non-negotiable. The third use is the %K and %D crossover. And this is the signal that standard RSI simply cannot give you. When the fast %K line crosses above the slower %D line, it signals that short-term momentum is accelerating upward. When %K crosses below %D, it signals that short-term momentum is accelerating downward. Standard RSI gives you one line crossing a static level. That is a blunt instrument. Stochastic RSI gives you two lines crossing each other. That crossover happens faster, reacts earlier, and pinpoints the exact moment momentum is shifting, not after it has already shifted. The most powerful signal this indicator produces is when the %K crosses %D while both lines are inside an extreme zone, either above 80 or below 20. A crossover below 20 signals that selling momentum has peaked and buyers are taking control, before price has moved significantly. This is the earlier entry that standard RSI cannot provide. We will build our first complete strategy around this exact signal. Before the strategies, let us set up the indicator correctly for day trading. To add stochastic RSI in TradingView, click Indicators and type stochastic RSI. Select the first result. The default settings, RSI length 14, stochastic length 14, %K smoothing 3, and %D smoothing 3 are the standard settings used by professional traders across all markets. We will keep these unchanged. In the Style tab, change the %K line to blue and the %D line to orange. This makes it immediately clear which line is which at a glance. Confirm that the overbought level is set to 80 and the oversold level is set to 20. These are our key zones. For the time frame, we will use the 5-minute chart. As with all strategies on this channel, the 5-minute time frame gives us the right balance between signal quality and intraday opportunity. All chart examples from this point forward are on the 5-minute chart using high volume assets, the S&P 500, Apple, Tesla, and Microsoft. Choose assets with strong liquidity and good daily volume. Illiquid assets produce unreliable stochastic RSI readings. Now let us move into the two strategies. Strategy number 1 is the stochastic RSI crossover pullback. The core idea is straightforward. In a trending market, we wait for stochastic RSI to pull back into an extreme zone, then enter when the %K crosses back above or below %D. This gives us a precise early entry point into the continuation of the existing trend. This strategy solves the exact problem from the opening of this video. Standard RSI tells you when a pullback has occurred. Stochastic RSI tells you the moment that pullback is ending, before price has confirmed it. The first step is to confirm the trend using the 50 midline. For a bullish setup, stochastic RSI should have been making consistent moves above 50 during the session. For a bearish setup, stochastic RSI should have been making consistent moves below 50. If stochastic RSI is choppy and crossing 50 repeatedly in both directions, the market has no clear bias. Do not trade this strategy in that condition. The second step is to wait for the pullback into the extreme zone. In an uptrend, we wait for stochastic RSI to pull back down into the oversold zone, below 20. In a downtrend, we wait for stochastic RSI to rally up into the overbought zone, above 80. Do not enter during the pullback. We are waiting for the crossover. The third step is to wait for the %K and %D crossover inside the zone. For a buy, the entry signal is %K crossing above %D, while both lines are still below 20. For a sell, the entry signal is %K crossing below %D, while both lines are still above 80. The crossover must happen inside the extreme zone. A crossover at the 50 midline is not this signal. The fourth step is to confirm with a support or resistance level. As with all strategies on this channel, one signal is never enough on its own. For a buy setup, the crossover should occur while price is at or near a known support level from the previous session. For a sell setup, the crossover should occur while price is near a known resistance level. Confluence between the stochastic RSI crossover and a price level significantly increases the probability of the setup. Here is a buy trade example. The session uptrend is confirmed. Stochastic RSI has been consistently making moves above 50. Price pulls back and stochastic RSI drops into the oversold zone, with both %K and %D falling below 20. At the same time, price is pulling back to a support level from the previous session. We now have confluence. Two separate reasons for price to hold at this level. Then %K crosses above %D, while both lines are still below 20. That is our entry signal. A strong green candle forms at this level, confirming that buyers are stepping in. We enter a buy trade at the close of the confirmation candle. Our stop loss goes below the recent swing low. Our target is a 2-to-1 risk-reward ratio. The primary exit is when the 2-to-1 target is reached. The secondary exit is if %K crosses back below %D before the target is reached. Exit immediately. The momentum shift has reversed. Here is a sell trade example. The session downtrend is confirmed. Stochastic RSI has been consistently making moves below 50. Price rallies and stochastic RSI moves into the overbought zone, with both %K and %D rising above 80. Price is simultaneously at a resistance level from the previous session. We have confluence, then %K crosses below %D while both lines are still above 80. Our entry signal is confirmed. A strong red candle closes near its lows. We enter a sell trade at the close of the bearish confirmation candle. Stop loss goes above the recent swing high. Target is a 2-to-1 risk-reward ratio. Primary exit is the 2-to-1 target. Secondary exit is if %K crosses back above %D before the target, exit immediately. But what happens when even a perfect crossover setup fails? There is one specific situation where this occurs, and if you do not know how to identify it in advance, it will cost you. Strategy 2 solves this completely, and it uses a signal that is arguably the most powerful thing stochastic RSI can show you. Strategy number 2 is stochastic RSI divergence. The core idea is this: when price makes a new extreme, a new low, or a new high, but stochastic RSI does not confirm it, the momentum behind that move is weakening. A reversal is likely. This is called divergence, and stochastic RSI detects it earlier and more clearly than standard RSI because it is more sensitive to shifts in momentum. Let us define the two types. Bullish divergence occurs when price makes a lower low, but stochastic RSI makes a higher low. Price is falling, but the momentum behind the fall is decreasing. A reversal to the upside is likely. Bearish divergence occurs when price makes a higher high, but stochastic RSI makes a lower high. Price is rising, but the momentum behind the rise is decreasing. A reversal to the downside is likely. The first step is to identify the divergence. Look for price making two clear swing points in the same direction, two lows or two highs. The second swing point must be more extreme than the first, a lower low or a higher high. Stochastic RSI at the same 2 points must show the opposite, a higher low or a lower high. Both stochastic RSI points should be inside or near an extreme zone. Divergence inside the oversold zone is a buy signal. Divergence inside the overbought zone is a sell signal. If stochastic RSI divergence is occurring near the 50 midline with no extreme zone involvement, this is not a valid setup. The second step is to wait for the crossover confirmation. Identifying the divergence alone is not enough to enter. We wait for %K to cross above %D after the second swing point is established for a bullish setup. We wait for %K to cross below %D for a bearish setup. This crossover confirms that the momentum shift has begun, not just that divergence exists. Here is a buy trade example. Price makes a clear swing low. Stochastic RSI is in the oversold zone. Price continues lower and makes a second swing low, lower than the first, but stochastic RSI at the second low is higher than it was at the first. Bullish divergence is confirmed. Then %K crosses above %D. Our entry is confirmed. We enter a buy trade at the close of the candle where the crossover completes. Our stop loss goes below the second swing low, the most recent price extreme. Our target is a 2-to-1 risk-reward ratio. Primary exit is the 2-to-1 target. Secondary exit is if %K crosses back below %D before the target, exit immediately. The divergence signal has failed. Here is a sell trade example. Price makes a first swing high. Stochastic RSI is in the overbought zone. Price makes a second swing high, higher than the first, but stochastic RSI at the second high is lower. Bearish divergence is confirmed. Then %K crosses below %D. Entry confirmed. We enter a sell trade at the close of the candle where the crossover completes. Stop loss goes above the second swing high. Target is a 2-to-1 risk-reward ratio. Primary exit is the 2-to-1 target. Secondary exit is if %K crosses back above %D. Exit immediately. That brings us to the end of this video. To summarize, standard RSI is a powerful indicator, but it is slow. It confirms signals after the optimal entry point has passed. Stochastic RSI was built specifically to solve this problem. It is more sensitive, generates signals earlier, and adds the %K and %D crossover, a signal that standard RSI simply cannot produce. The correct approach with stochastic RSI is always to identify the market condition first. If the market is trending and stochastic RSI confirms the bias above or below 50, use strategy 1. Wait for the pullback into an extreme zone. Wait for the %K to cross %D inside that zone, confirm with a support or resistance level, and enter on the confirmation candle. Exit at your 2-to-1 target or when %K crosses back in the opposite direction. If you identify divergence, price making a new extreme that stochastic RSI does not confirm. Use strategy 2. Wait for the divergence to form at an extreme zone, wait for the %K and %D crossover, and enter on the confirmation candle. Exit at your 2 to 1 target, or when %K crosses back in the opposite direction. In both strategies, the crossover is your entry signal, not the zone, not the divergence alone, the crossover. If you found value in this video, hit that like button and subscribe to our channel so you never miss any of our new content. See you soon.